Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Again, we're going to do ratios. This is going to be kind of part two. I know I went through a whole bunch of different ratios in the previous clip, about 40 minutes worth. This is going to be comparing ETF versus ETF, sector versus sector. Why do I do this? What's the whole point of this? Let's go through it real quick. I price an asset versus an asset, and where you gain purchasing power is when one asset outperforms another asset. It's a way to value something. Much like you go to the grocery store and you probably buy something based off of a ratio like how many ounces of green beans per ounce. So it's a dollars per ounce, and that is how you're finding what the value is of that product. So I'm doing the same thing. I'm doing a sector versus a sector and comparing it to history. Just like you would buy green beans or I don't know, whatever beans, green beans, corn, whatever it is in a can. That seems to be one of the easiest things that I can think of where you take a valuation, divide it by ounces, and then you compare it to history of what you normally paid for a can of green beans or corn. It's the same exact psychological thing that we're doing here. Asset versus asset compared to history. Now, we can do technical analysis on these ratios and see when things are starting to break against each other. That is highly valuable because we want to get something that's at a very low ratio against all of the other sectors that's breaking to the upside. That is highly, that's about as best timed and as best value as you can get is combining those two things. And that's why ratios are so important. It tells you time, it tells you value, and it tells you when things can be potentially turning. It's not 100% accurate. Nothing is. So you can buy something very cheap and you might have to wait a while for it to actually start to take off. It can break a downtrend and still go sideways for months or maybe even years after breaking the downtrend. So it's not a get rich quick scheme. It's nothing like that. It's just saying it's cheap, it's broken the pattern or the downtrend or whatever it is, and we are going to eventually work our way higher. So let's take a look at some of these ETFs, and I think maybe you'll be surprised, maybe you won't, on the valuations of some of these and what they're doing. So this is URNM versus XLE. One clear thing that you can tell is that we've broken the uptrend here back in 2022. There's your uptrend line break. This is where XLE outperformed. So if you were really early, you would have bought XLE in this time frame of 2021, and then you could see a vast outperformance all the way to the bottom here. Then we did another squeezy pattern up. So we squeezed up here in this corner here, and this is a good time to generally buy URNM versus XLE. And I know we've had a lot of strong performance out of XLE recently. I think that's probably going to change, and URNM is going to get, we'll just say it's going to light back up. We've broken that trend. We've come back, and we're kind of doing this like sideways retest. I don't know what the heck you call it. This here is actually still bullish for uranium, URNM. So yeah, this is where I would be picking up URNM, and URNM could outperform XLE here. I know that sounds weird. This is URNM versus natural gas. What this is telling us is that natural gas, I know this is a futures price versus a ETF. I don't really have a good uranium ticker symbol, but this is just saying nat gas is cheap. That's all it's saying. URNM versus XOP. Yeah, you know me. So this is URNM versus XOP, and what you're seeing here is we have a vast outperformance of XOP, a breakdown. We've been consolidating sideways here in a channel. Which way is this going to break? I don't know yet, guys. We'll have to wait and see which way this breaks. We're just going sideways in a channel, and there's no distinct direction that we've broken yet. URNM versus platinum. Let's go to the dailies here. So it looks like we've been kind of topping out here and just going sideways. And again, this is a platinum, the price versus a leveraged product. So we've just been moving in a channel sideways. Not much to discern here. And we don't know what's necessarily cheap and what's expensive given the short-term nature of this chart here because it only goes back to 2020. URNM that's the only data we've got. URNM has underperformed NDQ. It's gone to the downside and it's been underperforming for that period. And we'll see if we get a turn here or not. URNM versus the CRB index. This to me looks like it's like an accumulation for URNM. This is your move lower, your kind of pump, and this could be a big old move higher where URNM starts to outperform the commodity index. And it's still in this kind of big megaphone pattern. We also get the large, big buying pressure days versus the small pullback that generally works its way higher. URNM looks good and it's cheap against the commodity index. URNM versus OIH, this is the energy service companies. What I see here is a declining wedge pattern here that has broken to the upside in 2023 here. We've come up, we've pulled back. Is this a slingshot ready to break higher? Tough to say. That is what the chart pattern suggests, is that we would go higher. We're at support and that URNM could get a nice big bump to the upside and perhaps outperform OIH. Does that mean that I would not buy OIH, energy service companies? No, I would still buy individual companies in energy service and in uranium that possess really good chart patterns. URNM versus REMX. This to me looks like we're squeezing up into the corner and we could break to the upside. We'll see if that happens. And URNM could outperform REMX. We've got URNM versus COPX. Now this looks a little bit different. We could see copper outperform URNM. This is a trend line. We've broken to the downside, retest here, and that looks like we could head lower. Perhaps copper could outperform URNM, the copper ETF. Then we've got URNM versus SPX. It's just right on support, it looks like, is what I'm seeing here. Right on support, holding. Hopefully we can get a nice big move to the upside where URNM outperforms SPX. That could also mean that SPX falls and URNM doesn't fall as much. Going to XOP. So XOP versus REMX, it looks like it's ripping to the upside. That hopefully can continue. But that looks pretty good for a move higher, where XOP will outperform. XOP versus MU. This is a huge falling wedge right to the corner here. This is where you want to buy XOP in October 2020, November 2020, December 2020. That's where I bought a lot of my oil and gas stocks, but this still looks good to go higher. XOP versus OIH. To me, it looks like OIH could definitely outperform and we could go lower. That's the energy service companies. We have XOP versus GDX. As weird as this looks, guys, I mean, we could get a big move still with XOP outperforming GDX depending on what the market conditions look like. This is a clear, obvious pick in October and September of 2020. I did use these to some extent in my decision to load up into the exploration production companies. XOP versus crude oil, still looking good. Let's go to the dailies there. So XOP outperforming crude oil. We have a large, big downtrend line that is broken. And that was broken in September of 2021. And hopefully we can get a big move to the upside where it outperforms crude oil for a big, long period of time. XOP versus COPX. We are still cheap for XOP versus copper ETF. This is definitely a high. We turned back low. This is probably November of 15. And COPX outperformed that high. So COPX outperformed all the way till November, October of 2020. Then we had the big move, hit that, and I think we were going to probably move higher where XOP will outperform. OIH versus MU, this looks ridiculous for OIH. So cheap, and it looks so strong that we could move higher in the energy service company OIH. OIH versus REMX. OIH looks fantastic to continue higher, and it's cheap. So that's where I would go. Remember, OIH was also outperforming XOP, and OIH was doing okay against uranium, URNM. Looking at GDX versus gold, still looking incredibly cheap down here. It hasn't turned and started to outperform yet. We are still in the basing pattern of this pattern here for the ratio. GDX versus REMX. GDX is favorable and it's very cheap down here. So GDX is favorable to REMX and it still looks pretty dang good. That doesn't mean that it's going to immediately go higher. But what it does mean is that if a patient investor, if you accumulate in this general location, like you did down here and it rips, if this rips higher, you're going to get a vast outperformance of GDX against REMX. GDX versus silver, we've got the big reversal candlestick that looks like it could go lower, where SILJ could start to outperform GDX. We've got GDX versus URNM. As weird as this looks, guys, this looks like to me that GDX could outperform URNM, given this ratio and the trend line break and how low this is. What does that mean? Is the market conditions going to change to the curve on it, uninverting, and we get a crash in the overall markets? It's possible. It is possible. GDX versus XOP. As weird as it sounds, GDX looks good. We've got the broken down trend line, and we've broken that to the upside here into 2022, and we're just getting a little return move, and I think this is going to head higher. So GDX still looks really good. GDX versus COPX. GDX is incredibly cheap. It's in no man's land down here. GDX versus OIH. It actually looks good against OIH. GDX doing a retest move back here. We've broken out, doing a retest. We got to see it turn here, though. And maybe it's got some more downside to go, but still looks good. SILJ versus silver, still incredibly cheap for SILJ. We've got SILJ versus OIH. It looks actually good for SILJ. This is a retest move. SILJ versus XOP, it's really low in this expanding wedge, and I think that we are going to go way up. This also matches almost exactly the TYX-TNX ratio. SILJ versus URNM looks good for SILJ to outperform, and it's putting in a basing pattern. We've got SILJ versus RMX. SILJ is cheap against RMX, and I do think that we could see an outperformance of SILJ at some point for the patient investor. SILJ versus COPX, super cheap for SILJ. And SILJ versus TAN, SILJ looks like we could outperform and move higher against TAN. So SILJ is cheapest against everything. And that's it. The ratio charts are suggesting that SILJ is the spot we should be looking. COPX looks like OIH might outperform it. COPX versus GDX. GDX is super cheap up here, guys. Generally, when you're in this general location, it's going to come back down. It's going to come back down. It's probably going to come back down eventually. So GDX is looking better. And I'm not going to go through TAN, but that's what I've got for the ratios. And I don't use that exclusively to determine my investments for single individual companies. This is all sector driven. What it means is that you should awaken to the possibility that SILJ is the cheapest in terms of ratios, and that I know this is very hard to do. You buy the underperforming sector that's not performing, that's out of favor. And I know a lot of people, they're going to say, that's not doing anything. It's not. And that is exactly why it's coming up as cheap against everything else. Will it get expensive when silver goes up? My guess is yes. And that is the time you buy it, is when no one's looking at it, when everybody hates it. And this is telling me that everybody hates SILJ. So what am I going to do? Well, I mean, maybe I'll buy. I still like physical metals. Don't get me wrong. I really do like physical metals. But maybe there's some companies in silver, small silver junior companies that I'll buy a little bit of. SILJ is not all they're not like micro cap silver companies, guys. They're like EXK. I think there was Yamana Gold, and it was one of the larger ones. So it's those types of companies. Those companies are larger companies that have been underperforming, and those might be the ones to look at. That's all I'm saying. Uranium still looks good. We've got nice, big patterns. And if the market deficits of certain commodities go ballistic, these ratios will reflect that. Just because something doesn't look like it may, just because something looks like it may underperform doesn't mean that I would sell something. I would still hold on to what I think has just gigantic asymmetric bets to the upside, which uranium does. And I'm not going to sell anything in uranium. I'm not going to sell anything in my exploration production companies or anything like that based off these ratios. But this may impact what I might buy next. And saying people aren't looking at this, maybe I should accumulate some in this sector in these types of companies. That's what I use this for. But yeah, if you guys like this content, give me a thumbs up, subscribe to the channel, subscribe to the website, and We'll catch you guys next time. This is Finding Value.